Good afternoon, sir, and everyone else who's watching. This is problem 4 from the chapter 12 problem set. I'll be going over the solution for it. So to begin, the problem is that we're given the following account balances for non-cash current assets and current liabilities of the Suffolk Company. So we have it from December 31st, 2017, December 31st, 2016, as well as the following information that the net income for 2017 was $40,000. Depreciation expense for 2017 was $20,000. Now we're to assume that all sales and all purchases are on account. So to begin, the first thing that they want us to do is to prepare the operating activity section of the statement of cash flows using the indirect method. So what does that look like and what does that mean? So to begin, for using the indirect method, the purpose or the differences between the direct method and the indirect method when figuring out the operating activity section is that instead of reporting cash receipts and cash payments, the objective is to reconcile net income to net cash flow from operating activities. This can be found on page 579 of your textbook. A pretty good example is also on that page, Exhibit 12-14. But yeah, that table is pretty much right down here. So to break it down, cash provided by operating activities, your net income, and then you break it down into adjustments to reconcile net income to net cash, including depreciation expense, increases and decreases in accounts receivable, increase, decrease in inventory, prepaid rent, accounts payable, income tax payable, interest payable, and the overall net cash inflow from operating activities. That's how you break down the table. The second question that goes directly into this is why is cash inflow from operating activities greater than the net income? And that's because the cash inflow of $66,000 right here is greater than the net income of $40,000 given to us previously. Net income for 2017, $40,000. Because the depreciation expense of $20,000 has not yet been applied to this cash inflow. So depreciation expense, it doesn't affect the cash account. Additionally, there's less inventory being purchased. That could be another reason for it. Or there could be an increase in net cash inflow from an increase in accounts payable, meaning that the company's paying the creditors back slower. So once again, depreciation expense, it does not affect the cash account because once again, we're going back to the indirect method. Instead of reporting cash receipts and cash payments, reconcile the net income to net cash flow from operating activities. You're using the direct method, likely to face a different result, but indirect method using the current cash flows, statement of cash flows, that's the answer to question 2. And Sir Claus, that completes my brief. Thank you.